All right, L3Harris just dropped a really strong Q3 earnings report, and you better believe the market paid attention. In this breakdown, we're going to get into the key numbers, what management's saying, and, most importantly, what this all means for the stock. So let's dive right in.
Okay, here's how we're going to tackle this. We'll start with the headline numbers, that classic beat and raise. Then we'll unpack the story management is telling. After that, we'll look at their updated guidance for the road ahead, dig into the analyst Q&A, and wrap it all up with our take on the next call.
So let's get right to it. The bottom line, L3Harris came in with a non-GAAP EPS of $2.70. Now that's not just a number, it's a solid 10% jump year over year. And, you guessed it, a really clean beat against what Wall Street was expecting. That's the kind of thing that makes investors sit up and take notice right away.
And what about the top line? Revenue hit $5.7 billion. But honestly, the number that really matters here is that 10% organic growth. Why? Because that figure tells you this isn't about acquisitions or currency tricks. This is pure raw strength in their core business. We're talking higher volumes and big international demand. That's the real deal.
Now, if you want to know if this growth is going to continue, you look at the book-to-bill ratio. It came in at a really strong 1.2. Think about it this way. For every dollar of product they shipped out the door, they booked $1.20 in new orders from a massive $6.7 billion in new work. That's a fantastic signal for future revenue, and it's exactly why we saw the stock pop over 3% when this news hit.
Okay, numbers are great, but what's the story behind them? What's management actually telling us? Well, their whole narrative is about L3Harris being this absolutely essential partner for defense in a world that's, let's face it, changing faster than ever.
The CEO, Chris Kubasik, he used this great phrase, a trusted disruptor. And what does that even mean? Well, think of it like this. They've got the speed and innovation of a tech startup, but the muscle and connections of a massive established contractor. It's kind of the best of both worlds, right? And that puts them in a perfect spot to help the Pentagon hit its modernization goals. So, how are they pulling this off? It's not just one thing. First, they've improved their margins for the eighth consecutive quarter. A lot of that thanks to their LHX NeXt cost-saving program. Then you've got booming international demand from places like South Korea and Poland. And that big Aerojet Rocketdyne acquisition, it's already firing on all cylinders. Oh, and remember that ISR segment that used to be a problem child? It's now actually a source of strength, a real turnaround story there. Look, a great quarter is, well, it's great, but what Wall Street really cares about is what's next. And this is where it gets interesting, because management just raised their full-year guidance, showing they're feeling pretty confident about the future.
So here's the new outlook. They've bumped up their revenue target to around $22 billion. The EPS range is now $10.50 to $10.70, and they're pointing to segment margins in the high 15s. Now, one thing they didn't raise was the free cash flow target. They kept it at $2.65 billion. And yeah, Q3 was a little soft on cash flow, but management was all over this. They basically said, hey, this is just a timing thing. Don't worry, we expect a huge Q4 to make it all up. We'll see.
All right, now for my favorite part of any earnings call, the Q&A. This is where analysts get to poke and prod, and it really shows you what the market is truly thinking about, both the good and the potential risks.
Okay, so 4 big things kept coming up. First, that ISR segment turnaround. Management sounds really confident they've got it handled. Second, there's this huge demand for Aerojet's rocket motors. They're investing to build more, but they're telling the government, hey, we need you to sign some multi-year contracts so we can really go big. Third, there are major space and missile defense awards just waiting to be signed, but they're stuck in limbo till the government reopens. And finally, that cash flow dip? Yeah, they kept hammering home the point that it's just a timing hiccup.
Okay, so let's tie this all together. We've seen the numbers, we've heard the story. So what's our take? What are the key things to watch as we head towards the end of the year? Let me put it another way. What's the trade? Right now, where do you stand on LHX?
So let's look at the bull versus bear case. The bulls are saying, look, they're going to catch up on that free cash flow. And once the government gets its act together, those big contracts are going to start rolling in. On the flip side, the bears are worried. Can they really collect all those delayed payments? What if these budget delays drag on? And don't forget, competition in hot areas like space is absolutely fierce.
So, where do we land? We're rating the stock outperform. I mean, this was a textbook beat and raise quarter. The company is executing well, that 1.2 book-to-bill shows some serious demand, and their whole portfolio, it's perfectly lined up with where the defense dollars are flowing. Space, missile defense, you name it. The momentum here is undeniable.
This is not financial advice.